We expect GDP growth in China to decelerate to below 6% in 2022 from 8.1% last year. Regulatory uncertainty should gradually decrease this year as the establishment of a new and enhanced regulatory framework is expected to be mostly completed by the end of first quarter. Both monetary and fiscal policy stance are expected to be more accommodative than those of 2021. Growth deceleration beyond 2022 will almost certainly continue, and we will see market forecasts for 2023 GDP growth even below 5%. China experienced a major sell-off in tech stocks in 2021 as Beijing imposing regulations targeting internet monopolies and data security. The technology sector may have enjoyed short-term momentum, but we remain cautious about Chinese technology stocks. Despite the attractive valuation, we believe regulatory risk will remain a key overhang for Chinese technology stocks in 2022. Companies are pivoting from self-regulating just to avoid regulatory consequences, which itself will add costs and affect margins in the medium term. Not be surprised if there are potential earning downgrades for the sector in the first quarter earnings season. From a macro's perspective, the political agenda and the COVID-19 exit will be important for a positive view on China. While the focus of the regulation in 2022 will shift towards policy implementation and enforcement, details of many new regulations need to be clarified. The recent cross-the-board reserve cuts by the PBOC may help reduce borrowing costs and offset the economic slowdown. In response to downward pressure on the economy, China may increase its fiscal stimulus measures. While the reserve requirement ratio (RRR) cut represent an easing of its stringent policy stance, a genuine recovery in Chinese risk asset will require a very forceful policy shift. China may outperform other markets in 2022, given its easing cycle has already started. Valuation has also more reasonable, and there is still low ownership among global investors. But the immediate effect of a common prosperity goal was to slow down China's economy, which is softened throughout 2021. It was further decelerated by cooling property markets, power shortages, and slowing exports, sending markets into bear territory last year. The slowdown has led to many betting on the policy easing this year, on Beijing losing monetary and fiscal measures to shore up the economy. Signs have already emerged as the PBOC started to free up liquidity to lenders last month, may even cut interest rates, in which case banks and those preferred property developers which are ongoing into property consolidation would be the biggest beneficiary. Green energy is also still among the bright spot in the market.